You want me to kick us off, Ken?
Yes, please.
All right. Well, welcome investors to I know it's December, but this is the November 2025 Investing Roundtable. My name is Mark Robertson. I am founder and managing partner of Manifest Investing and a volunteer for the Mid Michigan chapter, which is most of the state of Michigan, everything but Detroit, basically. And I'm joined here by my dear colleague, and I hope he's not too beat up from shoveling snow, Ken Kavula.
No, I'm doing fine, Mark. I got my cough down to a manageable place right now. Let's see if I can take us through a few of the beginning slides on the way to visiting some stock recommendations for tonight. I use the word recommendations. That was a no-no. Some stock
We'll,
ideas for
we'll,
tonight,
we'll
okay?
pull up the disclaimer to cover you. And by the way, that is not a picture of either my front porch or my daughter's front porch. There's not enough packages there.
We actually had Amazon packages on our front porch today, Mark. I'll tell you, that's a rare thing for us, but it was there today.
There you go, sir.
This is an educational demonstration, folks, and anything we talk about tonight, we might own in our own portfolios. We'll try to disclose that, but we're basically giving you ideas for investment. We ask you to do your own homework. We ask you to make your own decisions, and we ask that you make yourself a regular at these roundtable events. We've been doing them for more than 16 years now. If you'd like to be added to our list where we can remind you each month of when the roundtable is and how to enroll in it, how to get yourself a spot. If you'd go to the Better Investing website and then hit chapters and then look for Mid-Michigan, on that site, which is our chapters webpage, if you'll scroll down to the bottom, you'll find a small form, a very small form. They'll ask for your email address and your real name, and I think one other piece of information. If you hit subscribe after that, you'll be added to our guest list, and we'll mail you an email once a month with a link to registration for the roundtable and telling you about the date of the roundtable. Almost every month that roundtable comes on the last Tuesday of the month, but occasionally holidays get in the way. And this year, Thanksgiving got in the way of our roundtable on the last Tuesday of November, and New Year's Eve is going to get in the way of our roundtable for December. So our roundtable in December will actually be on the first Tuesday in January. That'll be January 6th. So we invite you to come to that. And again, if you're on our guest list, we'll remind you about the date, give you a link for registration, and we'll also tell you about anything else that the Mid-Michigan chapter might be up to at any given time. I will tell you that right now the chapter is soliciting portfolios from clubs throughout our chapter and throughout the country. We're going to run a program at the end of January called Jamboree, and Jamboree is going to be focused on managing portfolios. We're going to talk about portfolios, give you some guidelines that we think are important about portfolios, and then look at portfolios, not so much with an eye on telling you which stocks to keep and which stocks to jettison, but rather talking about what you can set as long-term goals to probably make your portfolio perform a little bit better than it's performing at the present time. It's called Jamboree. We're looking for portfolios from throughout the country, and if you'd like to submit your club's portfolio, or if you have an under 20 stock personal portfolio, you could submit that as well. You tell us whether you want to remain anonymous or whether you want us to mention the club's name or your name, and we'll respect whatever you ask us to do. And we promise we're going to be lighthearted and kind and constructive as we talk about the portfolios. Where do you send them? Send them to kkabula1@comcast.net, and make sure somewhere in the email you mention the word Jamboree portfolio so I know what I'm doing with it when I receive it. Mark, is there anything else you'd like to talk about on this slide?
No, I usually do this slide in about 15 seconds, so you're way over.
I know I went way over on this one tonight. Okay, let's go to the next slide if we could.
I'll talk about this one.
Yeah, go on, talk about it. Uh-huh.
All right, so if you've got a friend or a family member that you're trying to get interested in investing, a number of people have come to me and said that they are exposed to some fairly useful stuff and introductory concepts and really trying to nail down what's important. So this can be a learning environment for somebody who's trying to get their feet on the ground. The other reason to consider it is the rate of return. The rate of return for the tracking portfolio since inception back in July 2010 is 16.2. That's the number you see up here at the top of the page. A matching investment in the Wilshire 5000 would have generated 14.1, which means that we're beating the market by 2.1. That's actually quite an achievement. We much prefer to be in this area, and we were, and now we want to go back. Greater than 5% better than the market over time, and that is our objective, but still 2% is a pretty decent achievement. So again, that 16.2% just basically proves that we have shared some potentially rewarding ideas over the years. And you can see that we have been in a bit of a slump, but Ken, I think I'm seeing a kind of a stop sign here, or it seems to be turning a bit. We're back up above 2% again, and let's hope that we continue to see improvement.
Well, if I were one of these fancy chartists, Mark, I might say that we went back and retested the 7-year low and bounced off of it twice now.
Oh, I
Okay.
can't believe you just did that. I had that thought. What he's referring to, everybody, is here. Oh man, I can't believe you did that. I've corrupted you.
I will tell you that I'm a little disappointed on our performance accuracy.
Yeah.
We've done a lot of work thinking that a 55% plus rate, which means 55% of the stocks actually making money, is a great goal to aim for and to achieve. It's achievable, and in fact, our accuracy rating maybe 6 months ago was as high as 53 or 54%,
Mhm.
and it's dropped back considerably, which means we have a boatload of stocks that are losing a little bit of money right now. Is that true?
That's well, a tiny bit. It's not a major epidemic or a catastrophe. What you're basically seeing is we're not completely invested in the Magnificent Seven, and we have several of them in the portfolio, but we are invested across all of the above investing, medium companies, smaller companies, and it's been a tough go for a couple of years for both of those, and it's just kind of catching up with us a bit.
Yeah, we've heard all these great numbers about the market the last 2 years, but we have to be self-aware enough to understand that those 20% plus run rates for the market in the last 2 years have been largely dependent on 4 or 5 or 6 or 7 stocks, and that if you kind of looked at the market without those stocks, you'd have a drastically different picture of what the overall return was from the market at that point. So I think you're true, Mark. We have to celebrate the fact that we're beating the market. It's a very aggressive goal to beat it by 5 points, and I'm happy to be over the 2 number right now, and looking forward to moving towards 3 in the next couple of months again.
Ditto. Here's a quick look at the top 20 holdings in the tracking portfolio. You will see some of those Mag 7 stocks up at the top, but we are not overweighted in them. And we do have a pretty diverse group of companies. So we believe that there's myriads of opportunity in the small and medium-sized companies, and we will continue to attempt to find them. So what you can do with this chart, any company that is in here, we've taken anytime it's been selected by a knight or a damsel or the audience, a guest knight or a guest damsel, we put $1,000 into it. So Microsoft has actually been invested in, how many is it, 6 or 5?
5, I think.
Where's 5? There they are right there. So 5 times Microsoft has been selected by either tonight or the audience. So $5,000 invested in Microsoft is now worth $111,000. And by the way, that was about $130,000 not long ago. Yeah, so from top to bottom, some pretty good stuff. Ken's going to bring Amazon here tonight. That's a 2-time selection. And that has managed to grow up to almost $32,000. So the portfolio is in pretty good shape. We are going to do some assertive trimming and gardening soon, possibly even before the next roundtable. And
we won't get into portfolio management to any degree tonight, but when you look at that little bit of a scorecard over on the right-hand side of the slide there, you'll see a number called MyPAR that's 8.4% right now, and that's the average in the Manifest Investment Database. That's the average potential return for all the stocks in that database, about 8.5%. The average return for our tracking portfolio is about 10.5%. So we're tracking going forward at about the same rate that we're beating the market looking backward. We'd love to get that par up a little bit higher in the tracking portfolio, and the way you do that is you move stocks with low par out of the portfolio and you buy stocks with higher par. You also focus a lot on growth, and when we're saying growth, we mean sales growth, and we'd love to see this sales growth up around 12.5, maybe even 13%. 11.3 is an excellent sales growth for a portfolio, but if you're going to achieve that aggressive goal of beating the market by 5 points, Mark and I both are pretty convinced that you have to get that number up around 12.5, 13 somewhere to make that happen. So again, you focus on the sales growth in your company, and then you also focus a lot on the par value that the company has at the moment. We have a lot more tips and tricks about managing portfolios using these dashboards that we're looking at, but we'll save that for our jamboree at the end of January.
okay. Well, here's your teaser slide. I'm here to tell the audience that this is your second chance at the basket here. Hugh McManus,
you talk about it, right? Good.
Yeah, Hugh wanted to be with us here tonight, and he was actually kidnapped and sent to Ireland in the middle of the night last night. So he'd been home for a couple of weeks, and he thought he could be here, and we are grateful for Hugh McManus. Hugh made this presentation at the Chicago National Convention back in 2014, where he selected Amazon. And if you think real hard about what Amazon looked like 11 years ago, they had a troubling characteristic of not really having earnings, not seeming to care about earnings, and most of us hated them. Well, he picked them basically saying that they're building this enterprise, and he went through a fairly exotic explanation. And the room was standing room only, over 100 people. Not a single one of you voted for Hugh's Amazon. And you're going to get a second chance tonight, although the competition from my stock is formidable.
He's already lobbying for your vote before you've even heard his presentation. Hughes only presented Amazon twice. Again, after the convention, he repeated that recommendation about 6 months later in 2014, but nobody has brought Amazon back as it's evolved into a pretty healthy growth company from its 2014 roots, when it didn't have a PE, it hardly had earnings, and the CEO was telling you at the time, listen, I'm focusing on building a company. I don't care what I earn at the moment. Come back and talk to me in 10 years. Well, it's been about 10 years, and let's do a little bit of talking tonight.
Nice.
You've all seen the trucks running around. It was Black Friday last Thursday. Yesterday was Cyber Monday. Today is supposed to be called Giving Tuesday. And this is the holidays 2025. It's a whole different place than it was 10 or 15 years ago. My wife and I were still traveling to the mall on a fairly regular basis. We were enjoying department stores. We were shopping and making that into kind of a sport with our families. And today that all has changed so that a lot of us are sitting around with our phones in a room all by ourselves trying to pick out just the perfect gift. Let's go to the next slide if you would, Mark. Shopping doesn't mean getting into your car anymore. You all know that. It means checking Amazon. And Amazon probably carries almost anything you can possibly think of on their consumer website. Let's go to the next slide. It's a popular stop for people, but there are other cyber stores that are available. Walmart is giving Amazon quite a run for its money. Target is trying to develop its own website and a cyber store for everybody to shop at. I'm very interested in what Costco is doing on the web, because more and more of Costco's business is shifting from the warehouse to the web as well. So a lot of our really big retailers are discovering that they can't survive unless they create something on the web, and they all seem to use Amazon as a model for a way that you can put together a website that people will use and actually buy things from. Let's do the next step. Many of us know Amazon as an online retailer, and it provides almost anything that you can imagine. I took a moment during the preparation for this presentation to go through the Amazon website, and I could not put in any product that I could dream of in their search box and not come up with 8 or 10 choices or more for whatever the product was that I chose. Amazon's business is actually broken down into some segments. They report in 3 segments, but they actually give you information on 4 different metrics in their company. And you might be very surprised at where most of the profit comes from. I talked to Copilot, which is an AI engine attached to my Microsoft computer. And if we go to the next slide.
Well, first I'd like to know if you searched for Mark's Ferrari.
No, I did not search for a Ferrari, Mark. No, I'm sorry. Except for maybe a Matchbox one,
well,
okay?
Moving on then.
All right. I talked to Copilot, which is an AI engine attached to the Microsoft browser, and I asked it to tell me where the profit was coming from in Amazon and how that compared to the profit coming from just AWS, and that's Amazon Web Services. And Copilot told me that basically the company, while it reports in 3 segments, it gives you data in 4 actual segments. They report on AWS, the cloud, and you can see that it's growing at a pretty good clip at 20%. But what was really surprising to me was that this cloud, this AWS, Amazon Web Services, and that was, excuse me, the premier, the pioneer in cloud computing, AWS was, and they provide about 66% of the actual profit, the operating profit from Amazon. The other divisions are North American retail, much slower growth, much lower margins, but extremely high volume. The international retail segment of the company, a little bit faster year-over-year growth, but much thinner margins because there's a lot of competition that they're having to move up against. And then the category that doesn't get reported, broken out, at least in Amazon reports, but gets reported is the advertising segment, which gets attached to all of the other 3 segments days. It's growing at 22%, and it's the growth engine for the company. It's the fastest growing part of the company, and it has extremely high margins. And Amazon is just learning to push the advertising as part of the whole package and monetize that to help the company grow. Next slide. The web services, again, is the most profitable division. About $123 billion is expected in 2025 fiscal year, but their margins are under pressure because they're not the only player in the game anymore, far from it. Their margins fell from 39% in 24 to 33% by mid-year fiscal 25. Part of that fall in margin was due to really heavy AI and infrastructure investments. So they're cutting into their margins so that they can try to keep their lead. They are the leader in web services, and they're trying to keep that lead by developing all kinds of new tools and developing the infrastructure that goes with those new tools. And you might use data centers as the key word for that infrastructure. The competition to AWS is really, really strong, and they've entered the field, they've entered the whole area very late, but Microsoft Azure is growing at 40%, and Google Cloud is growing at 30%, 34%, and that is much, much faster right now than Amazon's web services are growing, but Amazon is still the leader in providing cloud services globally. Again, Amazon is putting their money into trying to keep that leadership position, and they're putting $100 billion into this infrastructure, and that includes custom chips, data centers, power capacity, all the kinds of things that probably you and your investment club have been talking about for the last year. Let's look at the next slide. Here's the actual breakdown of the third quarter, and it's talking about the trailing 12 months. So it's comparing third quarter 2025 to third quarter 2024, and you can see that they were up about 11% year over year. That's pretty decent sales growth for a company this size. You can see that about 2/3 of their business is North American business. About 1/5 is the web services, that's the orange piece of the pie chart, and about 1/4 of it is the international business. So you put that all together, you have Amazon, the green piece, that's where the volume is. The orange piece, that's where the high profit is. Next slide. Their income is up dramatically quarter over quarter, excuse me, from third quarter of around 15 billion to third quarter 24, 15 billion to third quarter 25 of about 21 billion. That 38% year over year growth in net income comes in large part to a $9.5 billion plus coming from their position with Anthropic. Now, Anthropic is another company that Amazon owns a piece of, and Anthropic is basically an AI engine, just like a lot of the other engines that we know the names to: ChatGPT, Claude, Copilot, Gemini. Those are all different search engines. Anthropic is one of them, and Amazon had the foresight to get involved with Anthropic before AI became a buzzword. Next slide. That involvement goes all the way back to 2023 when nobody was talking about AI. Amazon put up $4 billion as an investment in Anthropic, and they tied Anthropic to a collaborative deal. About a year later, Amazon expanded that deal, added another 4 billion, making their investment 8 billion, which at that point was in notes, in loans that Anthropic had to pay back. In fiscal year 2025, portions of those loans were then converted to direct ownership of Anthropic. So Amazon now has a direct ownership stake in this company, which is not a public company. The conversion triggered a $3.3 billion gain in first quarter 2025. You saw the gain that it engendered in third quarter on the last slide. And by the end of 2025, Amazon expects its stake in Anthropic to be somewhere between 15 and 20 billion dollars. By early 2025, that stake was already worth almost 14 billion dollars. Next slide. Here's the SSG. I have taken the negative year, which was the COVID pandemic year of 2022. I have removed it from the graph, and you can see that sales-wise and earnings-wise, Amazon today looks very much like a good, steady growth company with earnings seeming to grow much, much more quickly than sales. We used to say that can't keep on going for a long period of time, but we're not certain how long the period will be before earnings finally match the growth in sales. Amazon keeps adding high margin businesses to the business mix and keeps dropping things that have no margin or very low margin. So Amazon, in a sense, is reinventing itself on every one of these fiscal years as they go by, and deciding the growth into the future is very difficult for a company that is this aggressive. I've decided on earnings growth of about 10% and sales growth of about 12%. And folks, I think I'm being extremely conservative when I use these numbers. Go on, Mark. Did you want to say something?
I think you got those backwards. Just to be clear.
What did I get backwards?
The 10 and the 12. 10 for sales, 12 for earnings.
I'm sorry. Yes. Yes, sales growth of 10, earnings of 12. Okay. Evaluation of management, the margins are moving in the right direction. Return on equity is really, really good. And most recently in 2024, they did it with a debt to capital that we might consider acceptable at 31.4%. Next slide. I am anticipating PE contraction. It's happening with all of the Magnificent Seven stocks. Their PEs are becoming, I would not hesitate to say less grand, but I'm not going to use the word reasonable. But they are much lower than historically they've been. I'm going to estimate the future high average at 40 and the future low average at 24. You add those together, that's 64 divided by 2, that's 32. That's what I'm using as my future 5-year average PE. Notice that the preceding 5 years, the PE average has been 47. The 5-year average was 47. That 32 is in line with value line thinking and with manifest investing thinking. It's very difficult to end up with a lot of folks making a call on PE values, but I think my average of 32 is certainly very reasonable. Next slide. Amazon does not yet pay a dividend, and it closed last Friday at 233.22. Based on my judgments, and I happen to own Amazon in my own personal portfolio, this SSG that you're looking at belongs to one of my investment clubs, and two of my investment clubs actually own Amazon in their portfolios. I'm suggesting that Amazon right now at the price of 233 or so is a buy. Excuse me. And the return, if you could go to the next slide, Mark. The return from my SSG of somewhere between 12 and 16% is certainly in line with the value line total return. A value line has said somewhere between 11 and 19% in the next 3 to 5 years. Manifest has said a par, an average return of 12.6. That compares to my number of 12. So I think I'm sitting absolutely in the right ballpark. I went to one more source just to check out my numbers. Next slide. I went to member sentiment and I looked at the total return value from member sentiment. Now, this is based on 527 studies. There's more studies than that that are done, but they've removed outliers from the entire set and moved it down to 527 studies that meet certain criteria as far as not being too far out in the ether somewhere. The mean return for that company is 16.7. My total return on my SSG was 16.4. So again, I think that I'm in the right ballpark with my assessment of this company. And next slide, if you would, Mark. Let's add another $1,000 in roundtable money for the third time in lots of years to Amazon AMZN.
Welcome to the party, Ken. Good stuff. And just a fun fact, maybe a little bit of trivia. Kurt Kowitz moved Manifest Investing to Amazon Web Services when it was still a toddler. It was just getting on its feet, and he saw a lot of potential, and we have been at Amazon ever since. Did a trivia for you.
Dwayne has corrected me, and now that he says it, I remember it. It wasn't in my head when I was talking earlier, but that year that I removed was not the COVID year of 2022. That was a year that Amazon made a terrible investment in a company that we won't name, Rivian Motors. And it just went completely bad for them, and they had actual negative earnings during that particular year. So I called it an outlier and left it out of the treatment for the company.
Thanks, Dwayne. I'd forgotten they'd done that. That was a pretty good hit to earnings.
I remember they did it, but in the heat of the presentation, it left my brain, okay?
Won't be the last thing I forget today. All right. Well, thank you, Ken. All right. So let's go ahead and take a look at a couple of alternatives to Amazon. You know, anybody can go back into the annals of the roundtable tracking portfolio and find some good picks and, you know, try to jump on that bandwagon. I thought maybe we could find something fresh and new here. I started last month with the Cash Flow Aristocrats. That's our collection of companies on a dashboard that have 9 or 10 years of continuous improvement when it comes to their cash flow. And interestingly enough, the two companies that I ended up with tonight, we went with Brown & Brown last month starting here. So we're going to end up back at this once again. Both of the companies that we're going to end up with are right here. You can grab the article on the Cash Flow Aristocrats and take a look at it. It's obviously a play on the Dividend Aristocrats, but this is an interesting concept. When you take a look at the companies that have the most consistent operating performance and strong cash flow, you end up with a group of companies. In fact, the top performing ones checked in at an average return for the last 10 years of like 23%. So this is not something to be ignored. and certainly something to be understood. You can get to the entire dashboard, which features all of the companies that have those 9 or 10 years of track record at that link at the bottom of the page. So I'm going to borrow a few slides from today's bull session. I thought I would just share that, yeah, we were celebrating Thanksgiving and a bunch of stuff this afternoon. So I'm going to actually borrow a little bit from today's presentation. It has to do with what we think of as the Sweet 16. A lot of times we put out a Sweet 16 list of stocks based on certain characteristics. In this case, I want a list of companies that have the combination known as a manifest rank of a high return forecast, but not too high, and a very strong / excellent quality ranking. When you get those two things going hand in hand, you are barking at George Nicholson's tree. All right, so that's really, I mean, most of the companies on here are going to look decent on a stock selection guide. There may be a couple of exceptions, but this is a pretty, I think Ken owns about half of them, so I know I'm in the right ballpark. At least half of them, right? No comment.
I own just 2 on this list, Mark.
Really? So is this list disqualified from further conversation?
Oh no, I think this is a great list because I really like the 2 that I own. Okay.
Okay. All right. So what I'm going to do is kind of walk through and show kind of a whittling process. You know, much like you would with a stick of wood and your best kitchen knife. I'm going to knock out the 2 with the lowest returns. Now, these are all good companies. These are not bad returns, but we got to whittle down to what we can actually consider and study. So I'm going to set Fujifilm and Innospec off to the side. Again, I'm not casting any aspersions on either one of them. We're just going to kind of whittle down. Now what I'd like to do is bring in the growth, because Ken has this obsession with growth, and he's right to have it. We really want to prevent too many more companies with low single-digit growth rates in the portfolio. So I'm looking at DuPont, which, by the way, is an excellent study for the right portfolio. If you believe in a potential turnaround in the chemical industry, it's got a lot of merit, a lot of stuff. But that 4.9 just does not stack up very well against the rest of these. British Tobacco, British American Tobacco, great company. They make products that a lot of us, a lot of you, might have heartburn over, but that 3.1, let's get rid of that one too. And Allison Transmission, great company, but 5.9%. So we'll set those aside and see what we've got left now. Now we have this list of companies. I've added the value line average return forecast as, again, another vote, another guide to what seems to be attractive or worth studying further. What I'm going to do with this group here is basically call out companies which are already in the roundtable tracking portfolio. And that's true for all of the ones with the red arrows. Nice, Brown & Brown, Gentex, Technoglass, which has been great for us, T. Rowe Price, another good one. And those 5 companies have been stellar performers. But one of the things we'd like to do at the roundtable is perhaps dig in a little bit deeper on less familiar companies and avoid the repeats every once in a while. So and I did throw MPLX off the list because of that LP. That LP can be an accounting nightmare for club treasurers. I'm not saying it's a bad company. It can work extremely well in individual portfolios. You can see that this is obviously something of a formidable company by that number, but it just not in an investment club environment discussion, at least not right now. And Mueller has that lowest. I love Mueller. I brought Mueller to the round table. In fact, that one should have a red arrow by it a few months ago at 7.8. So that brings us to these 4. Sprouts Farmers Market, which, by the way, would be a direct competitor to Amazon. Decker's Outdoor, which many of you out there own. Many of you are advocates and follow the company. Dorman Products, which is a company that's been a little bit unfamiliar to me. I fixed that a little bit today. And Vital Farms, a company that was presented by Matt Spielman a couple times this year so far. That's a chicken and egg company. mostly the egg part. The chickens remain alive and continue making eggs. But that's an interesting story. If Matt were with us here tonight, he would probably be updating and putting another helping of Vital Farms on the roundtable tracking portfolio. Deckers has been in the portfolio also. It's an Ann Manning selection from the recent year. So between that and Vital Farms, Ann this afternoon reminded me she also did a presentation on Dorman fairly recently. So apparently, Ken, we have been put on notice that we are borrowing ideas from the Houston chapter. All right, so let's talk about these companies.
As long as they're all profitable, I don't care where I get them from, Mark, okay?
That's what I've always said when I take your ideas. Good stuff. So Sprouts Farmers Markets versus Dorman Foods. I just thought I'd stack them up side by side. Sprouts is exactly what you think it is. It's kind of a combination of those type of Whole Foods type grocery stores and farmers markets. I like what I see there. These are actually relatively young companies, 20, 25 years old. And you can see that, again, very traditional grocery store. And I like any company who wants to help people live and eat better. Obviously, that is something that is in continuous demand, and it's not going away anytime soon. So I've not actually ever been to a Sprouts Farmers Market, but I have talked with people who have, and it got pretty high marks. Company on the right, again, I thought that they made stuff for like RVs and that type of arena. That's not the case. And in fact, these guys get a gold star, and they're already one leg up because they work with Chrysler, Stellantis on the Dodge Ram. So Ken, they do stuff for the Dodge Ram. I don't think I need to go any further. They obviously work on different other vehicles, but we have an emotional attachment to Stellantis, Chrysler, and Dodge here in this house. So I'm already very interested in the company. Now, I mean, I see other vehicles on this page, which you have previously been quite overheated about in the past, Fox Factory and the type of companies you've brought, Polaris. This has to be a company. I think, Ken, if you were able to vote in the audience poll, you've got to be coming after this company. So, I mean, and the neat thing here is I didn't know that they did all this stuff. When we first moved to the Detroit area to work on the Better Investing staff, I mean, the first soccer game we went to, I'm walking down the soccer field, and there are people reading Chilton's auto repair manual. And they're going through it, and they're proofreading it, and they're enjoying it. And so I think that they would actually hyperventilate over this picture. I mean, this is, they basically make all kinds of stuff for vehicles, including semis and frisky vehicles where you can have too much fun. So that's what they do. So let's talk about the two companies side by side. I think these guys are pretty much a mirror image when it comes to how their business models play out. The straw that stirs the drink, the most important number that you start with during any stock study is the growth characteristic. The slope of those red lines in the sales pictures, those are both at approximately 10%. And I would say they're pretty much interchangeable. Very strong. They both get a check mark for that. I would say that the earnings line in comparison to that for both of these, considering they are in somewhat economically sensitive environments, those are pretty steady and they're roughly parallel. So we're dealing with two up, straight, and parallels. You can see that the price characteristic at Dorman is a little more from lower left to upper right. You can see a bit of a flat spot here with Sprouts, but again, not something that I would necessarily worry about too much. They probably were a bit overheated, perhaps a little over their skis on the left-hand side here. And that shows up in the PE down here also. So again, when we think about companies, we think about first the growth, the G, the profitability is demonstrated by, in this case, earnings, the P, and the valuation, V, GPV. And you want to at least have a handle on what that characteristic looks like so that as you pick your PEs, you're basically putting together something that is, and Ken already used the word several times, reasonable. And so the reasonable PE of 20 for Sprouts Farmers Market, also in the 20 range for Dorman Products. These are two pretty solid companies with very demonstrable business models, and they seem to be, dare I say it, firing on all cylinders. That tells you which way I'm leaning. Well, they've got the Dodge Ram, so here they are side by side, calculated out. And again, the growth rates somewhere in that 9 or 10% range. Different levels of profitability, but both very steady. So a 10% growth rate, basically a 9 or 10% growth rate here. A PE ratio in the high teens, mid-teens here. Sprouts actually pays a little bit of a dividend, but you basically have a situation of a 14% company versus a 15% company when it comes to the return forecast in the next 3 to 5 years. And I would say that's pretty much a dead heat headed to overtime. Coin flip. I'm going to go with the company that is working with the Dodge Ram and add Dorman Products, ticker symbol DORM, to the roundtable tracking portfolio. All right, so Ken, I think we're ready for a poll.
Well, we give you all the chance to vote. There's only two of us tonight. We've explained that Hugh was kidnapped for his job. Cy is celebrating his birthday. Kim Butcher is ill, and Matt Spielman, our really dependable fill-in for the roundtable in the last year or so, is doing some charitable work with his church tonight, and we asked him too late to get him onto the program. So it's just the two of us tonight. It's a head-to-head battle in the cage. So we would like you to choose either Amazon or Dorman Products, or if you don't like either one of them, let's hit none of the above, okay?
Ken, I did ask Kevin Gologly about 15 minutes ago, and he's ready to go. I'm not kidding.
We're not laughing. I'm not laughing at Kevin. Mark has a tendency sometimes to ask Kevin at the last minute to step in, and Kevin has been very vocal and very helpful, but letting us know that he would appreciate a little bit more than 10 hours prep time to put together a presentation. So.
Well, he says he's fine with 15 minutes, so. I'll bet you.
I'm going to give you. We're up to 84% voting right now, so I'm going to give you just another 10 seconds or so, and then we're going to close the poll. I'm afraid when I close the poll, I'm going to have one very unhappy two guys presenter here. So here I go. I'm going to, I'd love to hit 90%, folks. We're at 87%. Come on, let's get 3 or 4 more of you to vote. We can hit 90%, okay?
I'm sure some of them wanted the opportunity to vote for Sprouts.
Not gonna get there today. We did go to 88, and I'm closing the poll, and I'm going to share the results. And we're going to add another $1,000 in Amazon to the portfolio.
There's always room on the Amazon bandwagon.
And I'm going to hide the poll. And Mark, we've had a couple of questions on can people access this presentation. Do we have a slide to show them how to do that?
A couple things. We'll actually put the PDF of the presentation in the manifest forum. You can send an email to either Ken or me and get access to the PDF. We'll also be putting this presentation on YouTube. It should be there later tonight or first thing in the morning, so you can actually access this presentation. Just go to YouTube, search on Manifest Investing Roundtable, and one of the things that I've been tinkering with here lately is actually adding a stock name or ticker to the search, and that's kind of fun too, Ken.
I've gotten a number of comments after I've sent out the URL, the HTTPS language for how to get to the site directly by typing it in. and I've sent this particular URL out to some of you, and then you've corrected my typing error. At least you thought it was a correction, and you corrected the manifest invest to manifest investing, and then suddenly couldn't find where this was taking you. That manifest invest is correct, folks, if you're typing in the URL into your browser. We suggest the easiest way to get here is just to do a Google search on Manifest Investing Roundtable, or in fact, just the word Roundtable, and this will come up. Do a subscription to our channel if you possibly could. It's free and it helps us out a little bit. If you've not already a subscriber to our channel, do that. And then we have about 16 years of presentations on this YouTube site, and that includes every single roundtable and every single bull session we've done in the last 16 years.
All right. Just a couple of things to remind everybody about. We do have bull sessions every Tuesday at 2. We did take last Tuesday off, but we will be here most of the Tuesdays in December. We also like everybody to know that there's a really nice, warm sharing of cups of coffee type environment with the Breakfast Club at the Heart of Illinois, Wednesdays at 9 a.m. I'll actually add a link to the sidebar at Manifest, but you can actually find this event by going to the Heart of Illinois chapter on the Better Investing webpage. And just a couple of the events coming up. I don't have all of our hopeful destinations in here, but we do have the December Roundtable coming up not in December, but January 6th. And then we are going to go down to Houston and defend ourselves on March 28th and have a great time with the Houston audience down there. Of course, the National Convention is in Chicago. I believe all of us will be there, and including Cy, trying to talk Hugh McManus into coming. And
Mark, those Jamboree dates, which we'll put on this list going forward, those Jamboree dates are going to be 2 sessions on January 29th in the evening and 1 session on Saturday morning, January 31st. So that's January 29th in the evening and the 31st in the morning. And we'll be putting out to our guest list a lot of publicity about those things. And again, if you'd like us to take a look at your portfolio, whether it's a club portfolio or a personal portfolio, send them out to me and just let me know whether you'd like to remain anonymous or not, and tell us a little bit about the portfolio, who belongs to, what it represents, and we'll try to do a really good once over on it and talk about short-term and long-term goals for that portfolio.
Yeah, can you give me those 2 dates again, Ken?
29 and 31, Mark.
Okay.
So we're this is the first time in a long time we've ended in our prescribed hour. In fact, we're 4 minutes early, Mark, so I'm feeling really good about that. Okay.
I'm okay with that. I think people sometimes enjoy us giving them back a half hour so they can go watch reruns on Netflix.
I'm looking at our questions. I just don't think we have anything coming up. Thank you all for the kind words. They're always greatly appreciated. When you're a volunteer teacher like Mark and I are, a kind word every now and then goes an awful long way to keeping us enthusiastic and keeping us working. So thanks, folks.
You know what's also helpful, Ken?
What's also helpful, Mark?
Voting for my stock.
Maybe I got to find a way to rig these polls. I don't know, Mark. Maybe I can do that, you know?
Hey, I bet you Kurt could come up with an algorithm.
Okay.
Good stuff. Are we clear to go?
I think we're clear to go. Good evening, everybody. Have a great Christmas holiday, because we're not going to see you again in the roundtable until January 6th. Mark, I'll be talking to you probably daily for the next 20 days or so. And we do have I thought we had a hand in the air, but it quickly came down. So we don't have a hand in the air. And with that, let's say goodnight to our audience, and have a pleasant winter.
God bless us, everyone. Take care, everybody.
Good night, all.